Open. The headline from Data Center Dynamics is that AI factories have a fiber problem. That's accurate, but it undersells the investment implication. The way that story is getting read by most of the market is as an engineering challenge. Latency, bandwidth, interconnect architecture. Fine. That's a networking conversation. The way I'm reading it is as a valuation problem that is actively mispricing deals in the market right now. I've seen ways get retraded. I've seen stabilized assets lose 150 to 200 basis points on exit cap assumptions at the 11th hour because a buyer's technical team came back and said the fiber path to the building runs through a single carrier, single conduit, no diversity. That's not a chip problem. That's not a power problem. That's a fiber problem. And it's not being underwritten at origination by the people putting capital to work in this space. So the institutional read I want to walk through today is this. The next tranche of durable value in AI infrastructure isn't in the GPU shed or the power purchase agreement, it's in the fiber-adjacent real estate and the colocation facilities sitting on dense, diverse, carrier-rich fiber routes. If you're a principal bringing me data center deals, the fiber story is now table stakes. If you can't show it to me, you don't have a deal you can get across the finish line with serious capital. The data layer. Let me put some numbers on the table. According to JLL's 2024 Data Center Outlook, Northern Virginia, which is still the largest data center market in the world by installed capacity, absorbed over 2,700 megawatts of new supply in 2023 alone. That number is extraordinary. But if you look at where the actual lease-up velocity is concentrated within that market, it's not distributed evenly across the geography. It clusters around Ashburn, specifically around the Loudoun County Fiber Corridor, because that's where the carrier hotels are, where Equinix has its DC campuses, where Zayo and Lumen and Crown Castle have lit and dark fiber running into the same physical exchange points. Assets sitting 2 miles off that corridor are leasing slower and pricing wider on exit. That spread is measurable. Green Street's data center coverage, which focuses on the public REITs, has been flagging interconnection density as a valuation premium driver since mid-2023. They're not putting a precise basis point number on it in public research, but the commentary in their REIT coverage on Equinix versus secondary operators is consistent. Interconnection revenue, which is recurring, contractual, and high margin, is what separates the 18 to 20 times EBITDA multiples from the 12 to 14 times range. Now come down market to where private transactions are actually happening. Real Capital Analytics, now MSCI Real Assets, has been tracking data center transaction volume, and 2023 came in around $48 billion global in data center-related real estate transactions. That's the headline number. What's buried in the deal-by-deal data is that the assets trading at sub-6.5 cap rates in private markets are predominantly colocation and carrier-neutral facilities with demonstrated carrier diversity. The single-tenant hyperscale shales, the 200-megawatt boxes in greenfield submarkets, are trading wider and financing harder because lenders are starting to ask the same question buyers are. What is this asset worth if the anchor tenant doesn't renew, and can it release to a second user if there's only one fiber path in? CBRE's 2024 Global Data Center Report names fiber connectivity as a primary site selection criterion alongside power, explicitly noting that hyperscalers are now requiring documentation of carrier diversity and route redundancy in their RFP processes. That's new language. 2 years ago that was implicit, now it's in the RFP. On the dark fiber side specifically, Zayo Group, private, backed by Digital Colony and EQT, has reportedly been running a quiet process around certain fiber route assets. Unity Group, which is public, trades around 9 to 10 times EBITDA on its fiber segment and has been vocal in earnings calls about the demand signal from data center operators looking for dedicated dark fiber capacity rather than relying on lit services. The spread between what those companies are paying to build or acquire dark fiber and what they're pricing it to AI infrastructure operators is widening. That spread is a real economic signal. The mechanism. Why is this happening now, and why is it accelerating? The dominant driver is the architecture shift in AI workload distribution. The first wave of AI infrastructure build-out, call it 2021 through 2023, was primarily training clusters. Massive, single-location GPU aggregations. You build a 50-megawatt training facility, you need power and cooling, you need a fast internal fabric, and your external connectivity requirements are actually relatively modest because you're moving model weights and checkpoints, not latency-sensitive inference traffic. That workload profile is tolerant of a thinner fiber diet. The second wave, Where the capital is flowing right now is inference at scale. Inference is a fundamentally different connectivity demand. You have distributed edge inference nodes that need to communicate with centralized model servers. You have multi-region redundancy requirements for enterprise SLAs. You have real-time API traffic at volumes that are genuinely straining backbone capacity. And critically, you have the emergence of what the industry is calling AI factories, facilities that are simultaneously training, fine-tuning, and serving inference, often for multiple tenants. That multi-tenant, multi-workload architecture requires not just raw bandwidth but carrier diversity and meet-me room access, because if one carrier has a fiber cut, you cannot have your inference traffic go dark. That's an enterprise SLA violation. That's contractual liability. The second mechanism is debt market pressure on existing operators. A significant portion of the colocation capacity built between 2018 and 2021 was financed with floating rate construction debt or 5-year term loans that are rolling over right now into a materially different rate environment. Operators who were running 60 to 65% LTV at 300 over SOFR are now facing refinancing conversations at 250 to 300 basis points wider, with lenders requiring updated technical due diligence that explicitly covers fiber infrastructure. That's forcing asset sales. That's the supply of deal flow I'm watching, where mid-market capital fits. The hyperscale layer, the $500 million, 100-megawatt campus transactions, is not where mid-market capital competes. That's Blackstone, Digital Bridge, KKR. They have cost of capital and relationship access that prices you out. The segment that is genuinely mispriced for capital moving sub $100 million is the Tier 2 and Tier 3 carrier hotel and colocation facility sitting on a fiber-dense route in a secondary market. I'm specifically looking at assets in the 3 to 20 megawatt range, multi-tenant, carrier neutral, with documented fiber diversity. Assets that are fundamentally well-positioned for AI inference demand but are being managed by operators who built a business for enterprise IT colocation and haven't repositioned their leasing story or their capital structure for the AI demand cycle. The deal structure that makes sense here is either a direct acquisition with a value-add reposition, upgrading power density from the legacy 150 to 200 watts per square foot to 400 plus watts, which is what AI inference tenants actually need, or a sale-leaseback with the existing operator, where I take the real estate and the fiber access rights and they continue running operations. The sale-leaseback structure is interesting right now because operators need liquidity to fund capex, and the bid-ask on outright sales is still gapped. A sale-leaseback lets them monetize the asset without having to agree on a terminal valuation. On the credit side, short-term asset-backed lending against colocation assets with strong fiber credentials is also interesting. The LTV math works differently when the collateral has verifiable carrier diversity. You have a more defensible recovery scenario in a liquidation, and that justifies tighter spreads and higher advance rates than the market is currently offering for generic data center debt. Counterpositions and risks. The bears have real arguments here, and I want to name them specifically rather than wave them away. First, fiber builds are accelerating. Zayo, Lumen, and a handful of well-capitalized regional fiber operators are actively extending routes into secondary markets. If fiber scarcity normalizes in the next 24 to 36 months, the premium I'm underwriting for fiber-adjacent positioning compresses. That's a real risk. The counter is that demand is also accelerating, and the lead time to permit, trench, and light new fiber runs 18 to 36 months in most markets, so there's a window. Second, the AI inference demand thesis depends on enterprise adoption curves that are not guaranteed. If AI application deployment slows, whether due to regulatory friction, model performance disappointment, or enterprise IT budget pressure, the inference capacity build-out stalls and the premium for inference-grade colocation compresses with it. I'm not betting on a specific AI adoption timeline. I'm betting on infrastructure that is already in demand for conventional enterprise colocation and has optionality to serve AI workloads. That's a more conservative position. Third, power is still the binding constraint in the markets I find most attractive. Fiber diversity doesn't matter if you can't get incremental power to increase density. Some of the best connected assets are power constrained in ways that cap the repositioning upside. That's an underwriting variable, not a deal killer, but you have to model the power upgrade path and its cost before you can commit to a return. The position I'm taking right now, I'm actively evaluating two types of opportunities. The first is direct acquisition of carrier-neutral colocation facilities in secondary fiber hubs. Specifically, I'm looking at assets in the Southeast and Mountain West where fiber infrastructure is dense relative to data center supply, power availability is better than primary markets, and the existing operator base is undercapitalized. Markets like Atlanta's edge submarkets, Phoenix outside the primary Chandler corridor, and the Denver metro have this profile. Asset size I'm targeting is $15 to $60 million all-in, with value-add capex to upgrade power density, and a target exit to a larger operator or REIT aggregator at a tighter cap rate than entry. The second is providing first lien asset-backed credit to colocation operators who are refinancing out of construction loans and have strong fiber credentials but can't get competitive terms from traditional lenders who are still applying generic data center underwriting criteria. Loan sizes in the $5 to $20 million range, 12 to 24-month terms, with a clear takeout path. The fiber story is what gives me conviction on the collateral. What I'm not doing is writing equity checks into greenfield hyperscale development in markets without demonstrated fiber infrastructure. The power story might be there, the land might be cheap, but if the fiber isn't there yet, I'm not pricing that risk. Close. Here's the summary. AI infrastructure capital is overwhelmingly focused on GPU count and power megawatts. The underwriting variable that is actually creating winners and losers at the transaction level right now is fiber, dark fiber access, carrier diversity, meet-me room proximity. The assets that have it are pricing tighter and leasing faster. The assets that don't are getting retraded or left at the altar. Mid-market capital that can underwrite fiber infrastructure correctly, not just read the spec sheet but understand carrier diversity, root redundancy, and meet-me room economics, has an edge in a segment that the large platforms aren't focused on. That's where I'm spending time. If you have an asset or an opportunity that fits that profile, or if you want to co-invest in something I'm already evaluating, DM me at Brody_official. I read and root every message myself.